Good morning everyone. I am Gia and I will be tackling about factory overhead variances. So, factory overhead costs are analyzed differently than direct labor and direct materials. This is because of the two elements, which is the fixed and variable cost. Factory overhead costs are budgeted and controlled by separating the factory overhead fixed and variable components. This allows us to prepare for the flexible budgets and the analysis of factory overhead controllable and volume variances. Flexible budget, a budget that adjusts or flexes with changes in volume or activity. So we have here Western Rider Incorporated factory overhead cost budget for the month ending June 30, 2016. Exhibit 8 indicates that the budgeted factory overhead rate for Western Rider is $6. So this is computed as budgeted factory overhead at normal capacity over normal productive capacity, which we have 30,000 total factory overhead cost over 5,000 direct labor hours, which equals to $6 per direct labor hour. But for Western Rider, to get this is for analysis purposes, we get variable factory overhead rate and the fixed factory overhead rate, which for variable factory overhead rate, we um, we divide budgeted variable overhead at normal capacity over normal productive capacity, which is for variable cost, we have 18,000 variable cost over 5,000 direct labor hours equals to 3.60 per direct labor hour. And for fixed factory overhead rate, um, we have to get the budgeted fixed overhead at normal capacity over the normal productive capacity, which we have in exhibit 8, we have 12,000 total fixed cost, and again over direct labor hours, which we have 2.40 per direct labor hour. To summarize, the budgeted factory overhead rates for Western Rider is variable factory overhead rate of 3.60 plus fixed factory overhead rate of 2.40, which we have total factory overhead rate at $6. Factory overhead controllable variance. It is the difference between the actual variable overhead cost and the budgeted variable overhead for actual production. Um, to get the variable factory overhead controllable variance, we have actual variable factory overhead minus budgeted variable factory overhead. If the actual variable overhead is less than the budgeted variable overhead, the variance is favorable. If the actual variable overhead exceeds the budget variable overhead, the variance is unfavorable. The budgeted variable factory overhead is the standard variable overhead for the actual unit produced. So we have standard hours for actual units produced times variable factory overhead rate. And when we go back to Western Rider Incorporated, for June, when 5,000 units of XL were produced, Again, we will go back to Western Rider Incorporated. For June, we have 5,000 units of XL units were produced. Then we come up with and we come up for then we come up for 14,400 of budgeted variable factory overhead. It is computed as 4,000 direct labor hours times 3.60, which we have again 14,400. The preceding computation is based on the fact that Western Rider produced 5,000 XL jeans, which requires a standard of 4,000. We come up with 4,000 because 5,000 units times zero point 0.8 times zero point 0.8 R per hour. Direct labor hours. The variable factor overhead rate is 3.60. It was computed earlier. Thus, the budgeted variable factory overhead is 14,400. During June, assume that Western Union incurred the following actual factory overhead cost, which is 22,400. Based on the actual factory overhead incurred in June, the variable factory overhead controllable variance is 4,000 favorable variance. It is computed as actual variable factory overhead minus budgeted variable factory overhead, which is 10,400 minus 14,400 rather, which we have negative 4,000 favorable variance. The variable factor overhead controllable variance indicates the ability to keep the factory overhead cost within the budget limits, because variable factor overhead costs are normally controllable at the department level. Responsibility for controlling this variance usually rests with department supervisors. Factory Fixed factory overhead volume variance. Um, we have again for fixed factory overhead volume variance, it is the difference between the budgeted fixed overhead at 100% of normal capacity and the standard fixed overhead for the actual units produced. So fixed factory overhead volume variance is computed as standard hours for 100% of normal capacity minus standard hours for actual units produced times fixed factory overhead rate. The volume variance measures the use of fixed overhead resources. The interpretation of an unfavorable and favorable fixed factory overhead volume variance is unfavorable fixed factory overhead volume variance. The actual units produced is less than 100% of normal capacity, while favorable is fixed factory overhead volume variance. The actual units produced is more than 100% of normal capacity. So, to illustrate the fixed factory overhead volume variance, we have again Western Rider Incorporated. For Western Rider Incorporated, we have 2,400 unfavorable variance. It is computed as 5,000 direct labor hours minus 4,000 direct labor hours times 2.40. It is, um, that's why we come up with 2,400 unfavorable variance. Because Western Rider produced 5,000 XL jeans during June, the standard for the actual units produced is 4,000 direct labor hours. This is 1,000 hours less than the 5,000 standard hours of normal capacity. The fixed overhead rate of 2.40 was computed earlier. Thus, the unfavorable fixed factory overhead volume variance is 2,400. So we have here Exhibit 9, graph of fixed overhead volume variance. This indicates that Western Rider's fixed factory overhead volume variance is unfavorable in June because the actual production is 4,000 direct labor hours or 80% of normal volume. The unfavorable volume variance of 2,400 can be viewed as the cost of the unused capacity, which is the 1,000 direct labor hours. An unfavorable volume variance may be due to factors such as failure to maintain an even flow of work, machine breakdowns, work stoppages caused by lack of materials or skilled labor, lack of enough sales orders to keep the factory operating at normal capacity. The management should determine the cause of unfavorable variance and consider taking corrective action. Favorable volume variances may not always be desirable. For example, in an attempt to create a favorable volume variance, manufacturing managers might run the factory above the normal capacity. However, if the additional production cannot be sold, it must be stored as inventory, which would incur storage costs. So, reporting factory overhead variances. We have um, to determine the factory overhead cost variance. The sum of the variable factory overhead controllable and fixed factory overhead volume variances. It is the total factory overhead cost variance. So a factory overhead cost variance report is useful to management in controlling factory overhead cost. Budgeted and actual costs for variable and fixed factory overhead, along with the related controllable and volume variances, are reported by each cost element. So we have again so we have again Western Rider um, as our illustration of a factory overhead cost variance for June. To further illustrate factory overhead account, the applied factory overhead for Western Rider Incorporated for the 5,000 XL jeans produced in June is $24,000, computed as follows. Standard for applied factory overhead, standard hours for actual units produced times total factory overhead rate, which we have $24,000. For total factory overhead cost variance, we have actual factory overhead minus applied factory overhead. Then we come up with 1,600 favorable variance. At the end of the period, the factory overhead account normally has a balance. A debit balance in factory overhead represents under applied overhead. Under applied overhead occurs when actual factory overhead costs exceed the applied factory overhead. A credit balance in factory overhead represents over applied overhead. Over applied overhead occurs when actual factory overhead costs are less than the applied factory overhead. The factory overhead account for Western Rider for the month ending June 30, 2016 is as follows. Actual factory overhead is 22,400 and the over applied factory overhead um is computed as 4,000 hours times 6 per hour equals to 1,600 over applied factory overhead. The 1,600 over applied factory overhead account balance and the favorable total factory overhead cost variance i- is shown in Exhibit 10 are the same. So, are the same. So, we will proceed to recording and reporting variances from standards. Standard cost may be used as a management tool to control costs separately from the accounts in the general ledger. To illustrate, assume that Western Rider purchased on account the 7,300 square yards of blue denim used at 5.50 per square yard. The standard price for direct materials is $5 per square yard. The entry to record the purchase and the favorable direct materials price variance is debit materials, which is computed as 7,300 square yards times $5, which is 36,500, and debit direct materials price variance, which is 3,650. And um, on the credit side, accounts payable is computed as 7,300 square yards times 5.50 dollars, which we have 40,150. The materials account is debited for the actual quantity purchased at the standard price 36,500. Accounts payable is credited for the 40,150 actual cost and the amount due to the supplier. The difference of 3,650 in the unfavorable direct material price variance, which we compute as 5.50 minus $5 times 7,300 square yards. It is recorded by debiting direct materials price variance. If the variance had been favorable, direct materials price would have been credited for the variance. A debit balance in the direct materials price variance account represents an unfavorable variance, and a credit balance in the direct materials price variance account represents a favorable variance. So we have work in process. We have here another entry where work in process is debited for 37,500, which is the standard cost of the direct materials required to produce the 5,000 XL jeans. Materials is credited for 36,500, which is the actual quantity of materials used at the standard price. and um, we were able and it is also recorded by crediting direct materials quantity variance. Again, if a debit balance in the direct materials quantity variance account represents an unfavorable variance, likewise, a credit balance in the direct materials quantity variance account represents a favorable variance. The journal entries to record the standard costs and variances for direct labor are similar to those for direct materials. These entries are summarized as follows. Work in process is debited for the standard cost of direct labor. Wages payable is credited for the actual direct labor cost incurred. Direct labor rate variance is debited for an unfavorable variance and credited for a favorable variance. And lastly, direct labor time variance is debited for an unfavorable variance and credited for favorable variance. Um, so we have here another exhibit, which again is Western Rider income statement for the month ended June 30, 2016. The income statement shown in Exhibit 12 is for internal use by management. That is, variances are not reported to external users. Thus, the variances shown in Exhibit 12 must be transferred to other accounts in preparing an income statement for external users. In preparing an income statement for external users, the balances of the variance accounts are normally transferred to cost of goods sold. However, if the variances are significant or if many of the products manufactured are still in inventory, the variances should be allocated to work in process, finished goods, and cost of goods sold. Such an allocation, in effect, converts these account balances from standard cost to actual cost. So that ends my presentation. Thank you.